either try to make myself relevant in a world that was becoming more and more irrelevant, or actually take the career risk at an early age and figure it out.
This podcast is for informational and entertainment purposes only and is not investment, legal, or financial advice. Opinions are those of the host and guests and do not reflect any affiliated entities. Investing involves risk, and past performance is not indicative of future results. The host and guests may hold positions in discussed securities. Now, please enjoy the show. Thejas, thank you so much for joining me today. Super excited to chat with you. All right, Thejas, you're the co-founder and co-CIO of the multi-strategy digital asset fund, Parataxis Capital. You guys manage roughly 150 million AUM currently, and you have a deep background in investing in both TradFi and crypto, having previously worked at places like Goldman, JPM, Ledger Prime, and more. All right, so I was going through your background. It looked like you launched right around COVID, like March of 2020. Is that true? Like, how was that launch?
That is. So my partner and I, Ed Chin and I, we got together in late 2019. We figured good time to launch a crypto fund. Bitcoin's price had rebounded from the 2018 low. And we got to work structuring the all of our legal docs, structuring the GP, and we had earmarked Q2 of 2020. COVID happened. We ended up kicking back the launch, or pushing back the launch a few months, just because the world was a different place, and it was actually serendipitous for us because when we were game planning and budgeting what we would need to do for marketing, that included quite a bit of travel, and just being out there. And so COVID actually changed the landscape, in that folks were forced to diligence us and effectively give us money over Zoom calls. And so we were able to have 10 meetings, 12 meetings, 15 meetings a day, for months at end. So I think it was a difficult time for the world, but it was for us as a fund manager. There were elements of it that worked in our favor.
Very interesting. All right, and also I saw that you guys have recently acquired Strix Leviathan funds, which were their crypto funds. Can you tell me more about that process and why you decided to make that acquisition?
One of the views we had last year, and we continue to have this year, is that there would be some consolidation in the space. Crypto is not, it's subject to market cycles. Operators and businesses are subject to market cycles. Our view would be that there was a handful of very good individuals managing assets where it would make sense to do something strategic with. I knew the CIO of Strix Leviathan for many years. So he was a personal friend, and at the time, I think they were looking at options, and it just made sense. Our cultures aligned, our LP base aligned, in that they looked at the space much the same way. We're a liquid fund, so and Strix is a liquid fund, and this is one of those worlds where the value of the new entity is greater than the individual sum of the parts. And so it was a transaction that made sense for both parties, and their CIO Nico Cordero came on board as a portfolio manager, and he's a culture fit for us. So a lot of things check the box, but the people aspect especially checked the box for us. So it was a transaction that made a lot of sense. It's one of those things that we're looking to do a bit more of, even for the next 18 months.
Yeah. So when you're assessing a potential acquisition like that, because my thought process is that, funds at this stage in crypto's life cycle are mostly people. But you're not only acquiring the folks, you're also acquiring the AUM as well. So how do you view that going forward? Are you thinking, we just want the people, we just want the AUM, or, the combination's obviously ideal? How do you view that?
It's a combination of the two. I don't think you can just buy AUM. And I don't think you can just buy people either. A lot has to fit. This is one of those transactions where it fit. There was a personal relationship, and it was just a win-win for both parties. I think, we've come across other funds that, um, perhaps wanted a transaction, but, it didn't check the box for us, on the either on the investor side or on the people side. Um, so a lot of things have to be right, for a transaction like this to work.
And also, you spent years in TradFi doing, I assume, probably quite well. And the kind of recurring joke here is, like, why would you jump ship? Like, why would you leave such a great position in order to go into crypto? Where, like, back when you got involved, it was very contrarian, and I'm sure your colleagues were like, Thejas, like, what are you doing? You're crazy.
Yeah, I mean, well, to be honest, Andrew, uh, when I entered Wall Street, this was, the mid 2000s. Um, I was attracted to the sales and trading, parts of an investment bank. I felt it was very team oriented. It was very competitive. The culture was. I played sports my entire life. So the culture was very much, akin to what I was used to playing sports, and so I enjoyed that. I wanted to be a part of that, and I was very fortunate to find my way onto a trading floor at Goldman Sachs. Um, a lot of smart people, really great technology, and they do things very, very well at scale. And I was attracted to that business. I was in the equity business on the program trading side, so we did a lot of index rebalances, for mutual funds, index fund managers. Did some index arb, merger arb, traded equities, futures, synthetics. So really, really good exposure for me, especially coming out of college. Uh, the equity trading business went, from I'd say analog to digital almost overnight. During my time there, um, there was a time where the trading floor at Goldman had north of 400 or 500 traders, trading individual stocks, trading individual parts of, individual sectors of the U.S. markets. That dwindled down to a fraction, just because of the use of electronic trading algorithms, just automation. And so the role of an equity trader, um, went from being an operator to really to someone that could operate, you know, many systems. And so for me, I saw the writing on the wall in terms of where an equity trader, or what the future for an equity trader would look like. Crypto was something I was introduced to. Well, Bitcoin was something I was introduced to in 2012. Uh, the guy sitting next to me on a trading floor was actually mining Bitcoin on his personal laptop and trading it, and he actually had a good amount of money, which I hope he got back from Mount Gox. And so he introduced me to Bitcoin. He, effectively helped me buy my first Bitcoin. So because this is before Coinbase, it's a very different, universe. The exchanges were, let's just say, not as trustworthy at the time. And so for me, I saw an ecosystem that looked and felt like the Wall Street I wanted to be a part of being architected. So it was a very simple decision, actually. Either try to make myself relevant in a world that was becoming more and more irrelevant, or actually take the career risk at an early age and figure it out. So I'd say, in hindsight, great decision, and I'm really glad I did that.
Very cool. So you had some experience at some different firms within crypto, Ledger Prime being one of them. At what stage did you realize, okay, I feel ready enough where I want to launch my own firm? And then were you and Ed already kind of noodling on, hey, we should do something together, or how did that evolve?
Yeah, yeah. So this is one of those, industries where if you're good at something, it does make sense to try and do it for yourself. Uh, I'm a big believer in owning, uh, uh, not only your own IP, but owning your future as well. And if you're good, if you have a skill and you can create value, yeah, give it a shot. Try it for yourself. It's just something I personally believe. I met Ed at a previous company. It was um, a digital asset merchant bank at the time. This is in 2017. I was running the hedge fund business there. Ed was running the advisory business. Um, and we both we're both about the same age. We both had young families. We both wanted to do something in the space, and so we both wanted to launch a fund. Timing is everything, as you know, Andrew. So in 2018, the market severe drawdown, not the right time to launch a fund. I went to Ledger Prime to run a book of business there. Ed went to Galaxy on the advisory side. We stayed in touch, and we both still wanted to do something, and timing was a bit more appropriate at the end of 2019. So we both got together, and honestly, it was started with a back of the envelope, drawing out what a strategy could look like, what we would need in terms of people, in terms of a tech stack, and how we would fundraise, and it kind of evolved into us launching our first fund just a few months later. So a lot of things worked out. I think with Ed, it was for me. I was very aware of what I'm good at and what I'm not, and I think the same case for Ed. And so I'd say we were good partners, and we still are. For that sake, there's no ego between the two of us. We're a pretty flat organization. We all wear many different hats, but there's also a total trust on both our parts. If I say I'm doing something, I do it, and vice versa with that. I don't have to second guess what his intentions are. So, I was very fortunate to have met him, and the timing just worked out really, really well.
When you guys were initially kind of blueprinting those initial strategies, what was the thought process? Like, hey, we're going to be, the best token pickers out there. We're going to do market neutral. Like, how are you? I assume it has to be some combination of your and Ed's skill sets, but what were those initial strategies, and how has that evolved over time?
Yeah. So our view in the world, our core belief was the crypto space is still very inefficient, very fragmented, and very young. As a result, an active approach that touches different parts of the market is not only the best way to generate alpha, but it made the most sense for us if we wanted to stay in business for 10 years, right? The ETFs weren't a thing back then. Grayscale had their products, but our view was ETFs would come and, a lot of passive money would flow into products that had distribution. So we took an active approach. We believed there were multiple ways to generate a return. We believed different investors wanted different things. And so, our first fund was one where we looked at both the liquid markets and, at the time, what we called liquid venture capital. So this is early stage projects where liquidity is usually sourced in the form of a token within 6 to 12 months. And, it was a different time. DeFi was just, becoming a thing. And there were a lot of really interesting projects with token values that would, go up exponentially. So it made sense as a source of alpha to have exposure there. But the liquid markets were moving as well. So it made sense to have exposure to the liquid market. So, our main fund, had exposure to many parts of the ecosystem. From there, we realized investors wanted different things, and it's a very difficult thing to try and package everything in one fund, because it's almost impossible to do that. And so we spun out independent funds that were taking a subset of what we were doing in our main fund, and only because we saw demand on the investor side for that. For instance, our second fund is geared towards more of the micro cap and high vol, but super high interesting opportunities. It's not meant for everybody. It's very volatile. But there's certain investors that want that exposure. Our third fund it's a yield fund. It's a lot of credit. We look at a lot of credit opportunities in the space. In a world where Bitcoin's up 100%, it's not going to do that. But there are folks that want fixed income exposure. And so it made sense to have a fund vehicle for that. And then we just launched a multi-strategy fund, which is meant to be controlled volatility, controlled drawdown, but allows us to play opportunities and arbs between not just crypto spot, but looking at the ETFs and looking at crypto-related equities and even options. And we realized the controlled risk of the fund would appeal to certain allocators, that care about volatility and drawdown. So I think we have a nice fund offering right now, and our approach initially was trying to steer everybody into one fund, whereas now we have multiple funds, and we can kind of, you know, um, uh, organically show a Chinese menu of what we have, and that approach has worked better.
And these new strategies are spun up purely based on, client demand or
Yeah, I don't believe in the build if you build it they will come strategy.
right.
Just because the crypto markets, um, they evolve at a much faster cadence than traditional markets. So something that's relevant that you think is relevant today may not be relevant in 6 months. So once we've identified explicit demand, usually we'll spin up a product or some offering to tackle that.
Have you noticed that there is a rough categorization between each different strategy and the LP base? Like, for example, the folks that want that yield, are they more, I don't know, family offices, and the people that want the small caps, are they more entrepreneurial, or is it kind of a mixed bag?
Yeah. So the small cap fund, it's largely high net worth, and it's folks who have ample. They usually are in our main fund, so they have active exposure, but you know anecdotally they find a couple dollars under the rug, and this is the fund that they want to throw their hat in. So um, the our main fund, it's our first fund. It's a liquid large cap fund now, where we focus just on catching trends in the ecosystem. That appeals a lot to family offices, RIAs, and that's a high net worth, ultra high net worth individuals. Um, that's the fund where we've been successfully continuing to raise capital for every quarter. Even in the midst of the current environment, there's still an interest in that fund. Only because I think that investor base, they've done their homework on a space. Um, they see the long-term opportunity. For them, what's important is finding a fund manager um, that can not only manage the portfolio risks, but manage the operational risks. And the example I'll give you, there were a number of fund managers that were market neutral or claimed to be market neutral in 2018. Sorry, not 2018, 2022. But they had 100% of their funds on FTX. So or they had a huge Terra Luna position, and so that's I think that opened up the eyes for a number of allocators, and they started paying a lot more attention to just operational risk, security risks, counterparty risks. So in our main fund, everything we trade it's a liquid listed token. We custody with qualified custodians. We look and feel like any other hedge fund. It's a U.S. based entity. We do our annual audits, and so that fund appeals to the investor base that has a thesis on the space, but wants the exposure, but wants a manager to manage that exposure. Our yield fund, it appeals to folks that have a fixed income mandate. If I'm being honest, I'd say private credit is a comp there. I think the yield that we can get in the space are a touch over private credit. So it's a big theme in the allocator space. So I think folks that have some sort of private credit mandate, if they're comfortable, kind of expressing that mandate in the crypto space, that fund is a fit.
So I guess take away the yield the yield strategy. Have you noticed that LPs, maybe they go into the primary fund and then a primary strategy, and then as they get more comfortable and they learn more about crypto and talk to you guys more, do they get more, quote unquote degenny? Are they like, all right, I'm feeling good. I want some 100x gains here, right? Or how does that evolve, or has not really been your experience?
No, we've actually had those conversations with folks who we didn't expect to ever have those conversations with. They So folks will come into our main fund and they may take a bet in our second fund. But usually, like I'll give you an example. Last year, Q1, Q2, I'd say the bulk of our discussions with LPs were around meme coins, and it was I don't know, there was 5,000-10,000 meme coins being minted every single day, and there are a lot of election-oriented meme coins that were trending, celebrity-oriented meme coins that were trending, and so folks just wanted to talk about that. It's we actually took that feedback and we built a model that would parse all of the memes on a given day, look at volumes, look at price activity, and then cross-reference, kind of our own sentiment scoring, looking at social media, and every single day it would spit out a handful of meme coins we felt would go viral at some upside. Because there's no science behind this. It's sometimes it's just luck, but at least we had a process and a methodology to identify, okay, we think these things are interesting purely because of X, Y, and Z. And so that was a big topic for LPs. They just wanted to learn more about that. But they're not the conversations we're having today. So these things are always changing.
Totally. Are any of your strategies capital constrained?
Because we're liquid, unless the market shrinks or the market depth shrinks, we could probably quintuple our size overnight and not have any issues on the execution side. I'd say if the market was to stay here at these levels, I'd say a 4x from here is probably where we would cap out at. But again, that's a good problem to have. If we can hit 4x, that means we have a good amount of interest in the liquid markets, which I think are picking back up from conversations I'm having.
Definitely. So, at what stage does a liquid fund within crypto? I guess it's really strategy dependent, but I don't know. I hear about some of these liquid funds, very few of them, but $1 billion plus. Is that I can't even imagine managing that. I'm like the what would you even buy? That where you could generate solid returns besides Bitcoin. So at what stage do you think that it gets just too unwieldy at this current market cap of where we at 2.6 trillion for total crypto?
I think you have to delineate between what's maybe a closet liquid passive fund from a liquid active strategy. If you're a liquid fund, but your position is maybe just a handful of names that you can't hedge or you can't buy and sell without some material impact in the markets, then it's fine. You're taking a passive view, but I don't know if you should be viewed as any different from an index. So the market doesn't really delineate between that and maybe what we do, which is a bit more active. We look at trends in the market. We look at we sometimes have a fundamental thesis on a token. We look at the underlying cash flows being generated by a certain protocol, and we'll build financial models on a token price itself. And we will trade around certain catalysts, which I think is more in line with what a traditional active equity hedge fund manager does, versus just saying, we have a thesis on this name. It's liquid, but we don't ever intend to sell it. We intend to only just invest in the ecosystem of this protocol. If you're subject to the volatility of that given token, it's a venture position that's liquid in my mind.
Makes sense. How do you think about generating alpha within the crypto market? And I know you guys are doing some different strategies, so I bet it's different per strategy, but just, I guess, broadly speaking, what are your thoughts on alpha within crypto?
I think alpha means different things for different people. For our main fund, alpha means outperformance against Bitcoin. And we've done that since inception. I think there are ways to do that over what I think is a full market cycle. So if you're able to kind of maximize upside capture in a bull run and just do a little bit better in a drawdown environment, compounded, those returns will outperform a pure buy and hold. If you're able to not over lever yourself, and I think leverage tends to kill a lot of funds in this industry, and you end up an example I use is, there are funds that perhaps missed the Jan Feb move this year, but then went leveraged long a name like Ethereum in March, and are still down 50% this year, right? And so, like, it's unfortunate, but crypto is it's a volatile product. So I think you leverage can kill you if you're not smart about it. Um, so we've done a good job there. We don't take leverage. We've we I think we've done a good job managing volatility, and we've even for the past year, our view was alts as a whole may underperform Bitcoin, and so we went overweight Bitcoin, and that move alone, it I think put us in the top quartile in terms of other liquid asset managers. Where there's a world where certain alts tend to outperform Bitcoin, and in November of last year is a good example. I say legacy L1 token is just kind of moving materially higher than Bitcoin. So there are times when it does make sense to have exposure to alts. I think we try to manage that as opposed to taking the view that alts are just generally high beta and you should just hold them because they can decay pretty quickly against a Bitcoin position. So that's one definition of alpha. I think the other definition of alpha is kind of removing itself from what Bitcoin does and just looking at more consistent risk-adjusted returns, which is why we launched our multi-strategy fund, because we recognize an investor base that frankly didn't care what Bitcoin did, but they wanted a certain return profile and a certain vol and drawdown target. So to them, that's alpha if you can do that in different market climates. And so we structured a fund to do exactly that.
When you're looking at a existing strategy or creating a new strategy, how do you think about the longevity of the strategy and how long it'll take for that strategy for the alpha within that strategy to decay, or are your strategies kind of broad enough where you don't really have to take into account, hey, will the alpha decay here over the course of the next 6 months or 12 months?
Yeah, we always have to take into account market evolution. The crypto market structure changes every 6 to 12 months. I think it's with any market. It just happens very quickly in crypto. The basis trade, for instance, in 2018, 2019, there's only a handful of players putting that trade on. And it was and it was an operationally difficult trade to put on at size. So Ledger Prime was one of those traders those shops that was very good at that. And so that represented edge and opportunity that others couldn't put on. Now you can effectively put that trade on through certain DeFi protocols. A mom and pop and anywhere in the world can do that. So, and the basis has come down from 40% to, I'd say either high single digits or low teens. Same thing with momentum strategies. You don't really see breakouts anymore on the charts. And you don't really see even, I'd say, altcoin, Bitcoin momentum really catching on. You kind of see this like oscillating pattern. And that's because there's the actual participants in the space, they're a lot more sophisticated. There's options now that exist that tend to create synthetic bands around spot price at times. And so if you're simply relying on a back test that's looking at prices from a different market environment, from a different reality, to be honest, I don't think you should be surprised that your strategy doesn't work in the future. So I think we're always of the view that the market's changing. We must evolve and change as well. But that's why we're an active manager. We're not pigeonholing ourselves to, hey, this is our approach and we're sticking with this for, all of eternity. I think we have the freedom and the ability in-house. We have a lot of smart people that work on within Parataxis where we can then go after new market opportunities because it's within our mandate.
When you are backtesting, what is the furthest look back period where you feel comfortable? Is like 12 months is like the farthest we'll go? Because as you mentioned, the market's changing so often that we don't really want to go 24 months because 24 months ago is totally different than today. Or how does that look?
The furthest I will go is probably after COVID, if I'm being honest, because prior to that, crypto markets were largely uncorrelated to equities, right? So and let's be honest, there wasn't a lot of derivatives trading. There wasn't a lot of shorting outright. So you can't. The running joke on our team is that, because we come across other traders all the time. The running joke is that there isn't a back test that we've seen that hasn't looked phenomenal, right? And it's because everyone's starting in 2015, 2016, and so it's just a chart that goes straight off to the right. So I'd say you have to take into account a lot of the market dynamics, and I'd say my preference is anywhere in the last, if it's worked from 2021 onwards, probably a good climate, because you've seen a bull market, bear market, you've seen equity market correlation, you've also seen some reversals due to catalysts, and if there's a conflict that breaks out in the Middle East over the weekend, Bitcoin takes a hit, and so you need that dynamic to exist in whatever test environment.
When you're looking at a token to potentially allocate to, are you looking at, do fundamentals of that specific token and that specific project matter? Or is it simply kind of on-chain metrics and, more quantitative metrics that you're focusing on?
Fundamentals matter in that you don't want to be investing your investors' capital in vaporware or something that could disappear overnight. So the fundamentals do matter from that aspect. But the other angle that matters is how that fundamental value will accrue to the token price. Just pointing to a metric and saying this token is undervalued and therefore we should own it, I think is just half the equation. If there isn't a way for that token price to move higher materially, to more reflect that fundamental value within a 6 to 12 month time period, then you may end up just owning something that decays over time. And that's just the nature of the crypto markets. Crypto is not an efficient asset class. The reason the equity markets trade to fundamental value at times is because a lot of long-term investing is done based on the way equity cash flows are generating and the way you would value a stock, which is all kind of point to one equation, 100 that was derived 100 years ago, and it's worked, and everyone subscribed to that thought process. Crypto is not like that. You can't. So you have to be humble enough to admit that price can and will likely deviate from fundamental value if there isn't, in the absence of a catalyst for token price to move up.
Yeah. So I guess speaking of that, the talk of the X town, if you will, the past few months has been really, hey, fundamentals are back, cash flow, token buybacks, etc. Do you guys, how do you personally view that in terms of this protocol, this project is generating cash and buying back the token, therefore, it is superior to a project that is not doing that, or doesn't that matter?
It's if you've done the work, it's a good talking point with an investor, because at least it shows that you're not just throwing mud against the wall, that you have some process and you've assigned some sort of intellectual capital to deriving why something is valuable. So you're able to tell a story. But again, if the token price, if you're not factoring in market structural realities, short interest, derivatives positioning, forced buyers and forced sellers, then you're ignoring, let's say, a big part of of what your job is. At the end of the day, if you're a liquid fund manager, you have to mark your books to market every single day, and your statements go out every single month, and it's a mark to market. You don't have the luxury of kind of marking things at cost when it's being traded every single day, and having a 10-year forward looking view. So you have to just, that's I think it's a double edged sword of being a liquid fund manager in this space. Everything's just being market. And the comps are usually against private funds that don't have to do the same. So I think it's good that we're talking a bit more about fundamentals. We're of the view that if there isn't a mechanism for that to move token price higher, then it's a consideration for whether it appears in our portfolio. And buybacks are good, but if something is still moving lower in the face of buybacks, you have to ask yourself why, and it's likely to do with large holders that are selling. So we look a lot at supply and demand imbalances. It's sometimes very simple to tell that there is a seller in the market by seeing how much of the price trades on the bid side versus the offer side. And so that was something that helped us avoid a lot of pitfalls last year. We just saw there was more of a consistent bid with Bitcoin, just given Michael Saylor, what he's been doing, and a lot of the ETF inflows, than there was with certain token prices that may have had some fundamental value.
How much weight do you put on the circulating supply versus, let's say, a product, really hype project launches and they have 4% circulating supply at launch? Is that, and over the course of the next 4 years, they're going to, have that full supply is going to enter the market. Will you not touch that? Because you're like, there's so much supply overhang there that we cannot go into that, even though fundamentally, sure, like great team, great product, or how do you view, kind of the token economics and total supply versus circulating supply?
It all depends if the demand side can overweight the supply side. If we don't feel like it can, then we'll likely stay away. How do you ignore that? I think that's sometimes as fund managers in this space, we create an inherent bias, just by virtue of spending a lot of time in a project ourselves, and we tend to ignore some of the realities of the crypto space. If there is a large amount of a token coming unlocked or coming into the open market, and the incentive there behind the holders of that token is to realize value immediately or over time, and there's a supply overhang, you can't ignore that. And so, we'll likely stay away 9 times out of 10, unless we see a reason why demand will outweigh supply.
For a fund at your size, do you guys have issues with liquidity of a lot of altcoins? Can you only play? Is your world of investable assets much smaller than, obviously than listed, of course, but can you only play in, like, I don't know, we'll call it 200 names, or is that totally, with different strategies, the world opens up to 1,000 or whatever?
For our main fund, I'd say we're in the top 50 by market cap. Our micro cap fund, we could play anything. It's smaller fund, smaller position sizes. Our multi-strat fund, it tends to be usually names that we can hedge, so there has to be a future or an option tied to that, and that kind of limits our size to I'd say the top 5, top 10. So it's a function of the fund itself and what we're going after. But again, it's like I've heard that narrative, like sometimes you're limiting yourself if you're not able to play everything. But I think there's a left tail here, with in terms of tokens and opportunity. Even if you trade on the top 3 exchanges, it doesn't mean you're worse than the guy that trades on the top 50 exchanges, right? Because any exchange after number 4 or 5 is probably a lot riskier. And so, we can achieve what we want to, even with a limited sample set.
And do you guys get involved with the narratives? There's the AI narrative, the NFT narrative, the L1 narrative, et cetera. Or you guys are not trying to play that, I guess what you call it a momentum game. But also it's more of a kind of X conversation, Twitter game as well.
It's more of a talking point for us. Again, we're not a venture fund. We're not trying to evangelize, projects here. We're trying to usually outperform a number. And I think playing into the narratives and talking about the narratives helps, because again, it creates that fundamental floor to some degree, and it tells an investor that you're not just again throwing money at vaporware. The AI narrative, it helped certain positions last year, which had a direct tie to Web 2 AI companies. The L1 narrative, there was a time where just being long alternative layer ones, because they were heaviest hit in 2022, made sense. and you're kind of playing this relative value trade, that trade went away within 6 months. So if the opportunity is there, we'll use it as a way to tell a story with our investors. But again, I think I like to just look at the supply demand of a given asset and look for why it will go up or down and position ahead of that.
How has it been being a liquid, investor in crypto, which is already pretty volatile, with our new administration, where a single individual can tweet and cause the markets to shift like trillions of dollars in a day or hour? It's funny because I'm like, man, I'm so happy that's not what we're doing, because that would drive me nuts that one guy's tweeting and this is happening. But how maybe you're taking advantage of that? I don't know. I feel like it'd be pretty difficult to do so, though.
We are now taking advantage of it. A single tweet or social media post moving the market's not a new thing. I think what is new is that this administration just has a wider reach and will have more of an impact, because it impacts not just financial assets, but it impacts really the perception on a macro space, and that kind of percolates. It just makes its way all the way down to Bitcoin price, just because of the correlation of risk assets. And so we are paying more attention to when certain people say certain things. I think we are always of the view that incentives will drive outcomes, and so we also are able to separate what's happening and the noise that's happening right now in the short term from what the incentive is for this administration come midterms and come in 4 years, and then it's not just the president, but his staffers, and the truth is there's a lot of for the first time there's a lot of pro Bitcoin, pro crypto folks. Their incentive is for the market to realize value, because if that happens, then I'd say the crypto community will be one of the largest donor bases, when they're raising money in 4 years. So like there are some, we're playing those, we're connecting the dots there. I think the fact that Bitcoin, there was a period of time, I think Sunday night, where Bitcoin's price was outperforming the S&P 500, just looking at the futures on Sunday night, right, for the year. I don't remember that ever happening, right? I think E-mini futures were down, for the year 2019, 20%, and Bitcoin was like 17, 18 for the year, right? Like, so we are also paying attention to the relative performance. So I think a lot of what's happening is noise. Yeah, we have unless you know what's the president's going to tweet, it's very difficult to kind of position ahead of short-term events. But we're taking a bit of more of a mid and long-term view on what the long-term incentives are.
Yeah, no, it's pretty wild. It's like, hey, if we get this group of people rich, the money that they make, they'll donate to us. It's pretty crazy. But it's all in theory. But
fortunately or unfortunately, it's the way of the world.
Yeah, that's actually true. That's very true. All right, so if you're looking at, if you had to choose some most valuable signals, whether it be like quantitative signals or on-chain data that you're looking at, how would you like rank the top three? Let's call it.
So we look at three types of signals: fundamental, technical, and structural. Fundamental, basically, wallet growth, transactions, just individual on-chain metrics, but also looking at what, the macro space and what's happening in the global economy. That's more of a long-term signal. Technical, let's say, is more medium term. That's the price trends, volume trends, Fibonacci retracement levels. Crypto is still 80% retail driven in terms of day-to-day movements. It's very, and retail traders all look at the same set of moving average crossovers. So that looking at technical signals is a good indication for what retail will do with perp leverage. But then we pay a lot of attention to structural signals right now, and that is basically the underlying mechanisms that shape how the market and its participants are forced to operate within. So it's liquidity, it's leverage, it's margin requirements, it's risk premia. It's really anytime there's a forced buyer or forced seller, that's usually a better indicator, and it's a bit more predictive in terms of what the market will do in the short term. And that's been the easiest signal to play, if I'm being the simplest, I would say, just because we can see what the leverage is, we can see where different stops are. And the example I'll give you, even yesterday, there was a big liquidation on an ETH whale. I think it was 75 or $100 million was liquidated on a single wallet, and we knew what his liquidation level was. It was at 1,400. We're maybe right below 14. So we had a short going into it, but then we flip long the I think right after, and that's when you kind of see the V-shaped recoveries. That dynamic still exists because folks want to take leverage, and so we've taken a lot of our views from a lot of structural signals this year. So anytime there's forced buyers or sellers, for us, it pays to be taking the other side at times.
Very cool. All right. So if you can make one change to the trading ecosystem within crypto, and that could be, I don't know, I'm keeping it pretty broad. What would that change be for you guys to operate more efficiently, effectively, just make your lives easier?
Yeah, I wish exchanges didn't offer leverage beyond more than, I'd say, 3 or 5x.
Interesting. Isn't that good for you though? Honestly,
No, we're not a market maker, right? We're not. When I say leverage, I'm not talking about options. I'm talking about the ability for someone to go 100x leverage on Bitcoin price. That's basically it's unnecessary, right? The only winners there are the exchanges, in my view. Yeah. So because what it creates, it creates. I think crypto is and will continue to be very volatile as an asset class, and that's the only reason why it can go up and have asymmetric returns. But this leverage tends to create these kind of exaggerated levels of volatility in the short term, which I think scare what would be longer term allocators of capital to the space. So I don't know anyone that wants or needs leverage beyond 5x. Maybe certain market makers. I just think it creates really, really, it's a bit of a moral hazard, and it creates really poor incentives. Given that, again, the only winners there are exchanges that can generate the fees. That's one, and the other, I think, if there's some way to kind of stop the correlation between the tick for tick correlation between equity markets and Bitcoin markets. So maybe, I mean, it's the way the market evolved with the CME futures, but the reason that correlation exists is because some macro fund out there or some quant fund is trading CME futures of Bitcoin and CME futures of the equity markets. But it's the only reason why tick for tick Bitcoin has that, move up or move down. That hadn't existed prior to COVID, right? So that is an unfortunate, I guess, reality of the way the market evolved. But I think that it's the leverage. If we can, as an industry, move to remove leverage off exchanges, it would, I think it would benefit the industry as a whole.
Do you foresee a future where crypto markets will decorrelate from TradFi markets? I just, if anything, in my mind, it's almost like they're getting more intertwined and becoming almost, they're just merging into the same thing, just like markets.
It will take time.
And sorry, when you say time, you mean like, if you had to throw out a guesstimate, are you talking 10 years, talking 2 years?
I'm talking at least 10 years plus.
Okay. Wow.
I mean, for a complete decorrelation, similar to gold, if that's the analog gold, and the Bitcoin is right now it's viewed as a risk asset, and so it's viewed as a risk asset by very, very large players who are maybe an order of magnitude larger than even the biggest players in crypto, and so they can keep that correlation alive. And so I think as more capital comes into the ETFs, as market makers start viewing and start pricing the risk of Bitcoin differently than they would equity markets, there's going to exist this relationship. It's not going to disappear overnight. I think crypto for now, like if you have a large equity basket and you're unsure what's going to happen Monday morning, I think spot crypto is being used, or even CME futures, when it opens 6 p.m. on Sundays, is being used as a hedge for equity exposure. And the size of these players are just so large that they can kind of keep that relationship going for as long as they want.
And you mentioned previously about, team and culture. How do you think about building out a team, and how would you describe the culture at Parataxis?
Yeah, I think your team not only has to have the capabilities, a lot of people with capabilities, a lot of smart people out there, um, but there needs to be a trust factor, uh, a trust factor in that. I don't believe in micromanaging folks. I don't believe in kind of we're not a. I always tell people we're not a place where you start your career, because when you start your career, you need that. You need someone kind of looking over your shoulder, teaching you the ropes. And it is I remember on the early Wall Street days, it was a very teacher apprentice type of dynamic. And that's why I still think the big banks are really good places to start your career, just because you get that boot camp. Uh, we're a place if you got skills, to see what you're made of. And so everyone that we brought on board, um, they have a skill set that's complemented us in some way. They organically found themselves in crypto, and they like the space personally. They're invested in the space either through our funds, or they personally have a lot of on Bitcoin. And so they're incentivized for the market to grow. But they want to be in the space. They have no desire to go back to a traditional seat, but they also don't need to be managed. I think we're a remote team. I trust that everyone is doing their work. We have calls multiple times during the week, but like we have one guy or two guys that are focused on microstructure, and they're building quantitative signals. We have another guy that's just looking at the vol markets and structuring trades. We have another guy that's looking more at thesis oriented investments. I look at just kind of managing risk overall. My partner Ed looks at structuring really interesting opportunistic trades, and almost like a special situations desk at a bank. And so we all kind of play our role, but there's an inherent trust that everyone's not only do their work, but not represent a risk to their firm. And I think that's sometimes, if you don't have the right people, if you don't have with the right character, it's very difficult to manage that. So I'd say we have a culture of really good, smart workers that owns their character is really important. I don't have to worry about folks being on the front page of the Wall Street Journal tomorrow because of some, nefarious activity. And we just mesh well, really, as an organization. We get together a few times a year, just to team build and to bond, and and just be social. And in the summers, usually that involves everyone's families, and everyone's families gets together. So there's a very it's a nice environment in that sense. And I'd say we're a small team. We're a team of 9 right now, and we've purposely kept it that way. I've seen the mistake of other firms just hiring for the sake of using it as a proxy in terms of like to get a higher evaluation, but then they're forced to fire a lot, which I think is really, really bad for team morale. We've largely kept the same team since existence, and we've even added this year. So we're very selective with who we bring on. Um, you know, I think everyone that works with us will agree to that. It was a long process. Usually they've come from referrals in house, so there's some trust there. And they usually want to work in this industry, organically. So I think a lot of long-winded answer there, but this was an important thing for us because I think if you have the wrong team, the wrong culture, Even if you have a good product, it could impede growth at times. So I think we have the right. I honestly think we have the best team in the industry.
That's awesome. All right, if you could wave a magic wand and you could change one thing in terms of the fund operations, whether it be like tax, fund admin, whatever, what would be that shift or that change or to make magically better?
The tax component, it's still only because crypto operates on a different rails, and I think our tax partners and our auditors, they're light years ahead of where some of their peers were just a few years ago. And so we're actually able to have very in-depth conversations with our auditors in terms of like, what is this protocol? Like, how does it generate, value? What these tokens do? What is this token? How does the token? And so we're actually able to go into the weeds. And so they're able to do their work, but just purely because I think a lot of systems and processes are still are still dependent on automation of the old rails. It's kind of a brand new process that's being built and architected, and it'll get better over time. But what that means is, for U.S. investors, sometimes, K1s can be delayed, right, at times. And actually, this year everything's been on time, but there are instances in the past where K1s are delayed, and for U.S. investors, that could create an administrative headache. So that's just unfortunately, that's just an administrative reality of the space. But I think it's been getting better over time. So that's the only thing that comes to mind. Our fund admin is I think a rock star. They know the space. They're able to track all of our positions in real time and really act as that back office for us and cross check anytime there's a transaction. We know exactly what why and so I think the ops side is certainly a lot more efficient. And the thing I also appreciate about the crypto space, in the traditional space, there's a very big distinction between front office, middle office, and back office. I think in crypto, it's almost sometimes all in one. As a PM, even though I'm the CIO, like I have to know where all my positions are. I have to know, if a transaction occurs, usually it's because I'm initiating a transaction as the holder of the keys. So at any given point in time, I have to know what my counterparty exposure is, what my operational risk is, and it's not something you can just pawn off to a back office person, right? So I think in the crypto space, you have to have that appreciation with it, which I think a lot of fund managers, if they're used to a certain type of dynamic in the traditional space, they struggle in the crypto space just because it's sometimes very difficult to delineate, I'd say, the ops roles from the traditional PM and trading roles.
All right, 10 years from today, you're back on the pod. Where is Parataxis?
10 years today, we're if not a couple billion in assets. We're our team has grown to go after different parts of the market. I'd say I would, my personal role would be focused more on just overall company strategy on risk management and kind of viewing and looking at organizational risk. We've hired some really great people to help us scale and kind of own independent parts of the portfolio. And we've grown with the market. We stayed alive and we made our investors a lot of money.
Amazing. I love that. All right. It is time for the closing questions. These are supposed to be rapid fire, but kind of do what you want. All right. What is the best advice you've ever received?
The best advice I've ever received. Let me think about this. It has been outwork your peers. And I received this from my boss and my mentor at the time at Goldman. I didn't go to a target Ivy League school. I didn't have a certain pedigree to my background. So the advice I was given was just outwork everybody, which is what I did. Right? So that means coming in before everybody, staying later. That means just spending more time educating yourself, spending more time reading the charts, spending more time just reading in general, and just when other folks are out Um, Drinking on a Thursday night. Usually, I'm the one that was still in the office. I think it's a character trait. I still, uh, I think I still demonstrate on a day-to-day basis. It's something I will pass on to my own kids, right? So I think but that's helped me a lot, just purely because I needed that, and I couldn't rely on external factors for my own success.
Love it. All right. How has being an entrepreneur slash fund manager changed you as a person?
In the crypto space, if you let this market dictate your emotions, uh, you will have a very difficult life.
You'd be a schizophrenic.
Yeah, you'll be a schizophrenic, but you'll also, you'll subject yourself to dying of a heart attack or something silly, just because. And so but I had to learn that, and um, it was not easy, but I'm able to now remove myself emotionally from day to day market events, and that's helped actually in the way I think about risk and the way I even demonstrate, or with the way I communicate to investors. I think sometimes there is, when you're a first time fund manager and you're taking in other people's money, and you have a down month, for instance, it's a new feeling. And so, but I think at the end of the day, like, if you're able to demonstrate your process, you're able to demonstrate confidence to your investors, at the end of the day, you realize they're investing in you. And so, but that took some time to understand.
What is the most contrarian opinion that you have about the crypto space right now?
For the foreseeable future, Bitcoin will likely lead the alts. Um, I'm not talking about individual weeks or days where an altcoin rallies, but in terms of sustained trend, I think Bitcoin leads. Um, it's this thesis we had last year. It worked out. I think just holding alts because of something they've done in the past, it's analogous to holding a levered ETF. You're just going to subject yourself to decay over time.
What's a piece of content, whether it be a blog, a book, a podcast, etc., that had a very big impact on you?
I actually read David Svensson's uh, book on portfolio management when we started the fund, because coming from a trading background, I think it's a very different role than actually structuring a portfolio and thinking about portfolio level decisions, especially when you have multiple strategies working. So that was very helpful, especially thinking about how to communicate to an investor when we're rebalancing and why. It was very helpful for me in terms of how we framed our thesis and how we framed our reasoning for positioning.
Very cool. All right, last one. What does success look like for you?
It's got nothing to do with money, if I'm being honest. I think money's a tool that helps you that allows you to better allocate your time. But at the end of the day, like, it's the legacy you leave behind. For me, it's my kids, and if they're able to do things that I couldn't do, or I didn't have the opportunity to do, and they're able to be the best versions of themselves and really impact the world, that's success to me.
Amazing. Thejas, thank you so much. I appreciate you taking the time here. People want to find out more about yourself or learn more about Parataxis. Where should they go?
Yeah, so parataxis.io is our website. Our email, the generic email, is info@parataxis.io, but I can be reached directly as well as at my first name at parataxis.io.
Amazing. Thank you, sir.
Thanks, Andrew. This is fun, man.